Hi again, everyone. I always love this sort of discussion that I get to have with top VCs because there's always something new to talk about. I think this year the sort of defining trends are maybe direct listings, dual shares, and probably the future of Softbank, which I'm hoping we can kind of get into. But, Theresa, let's start with you. You, a few years ago, started a venture fund, Aspect Ventures, one of the few female-founded venture funds out there. It was a very big deal. But you're here representing a new firm suddenly, Accrue Capital. So tell us what happened.
Yeah, so we had two funds for Aspect Fund 1 and 2, and that was 5 years ago. It's been a great run, and on sort of great women-founded firms in addition to Anne's.
Yes.
There are many other awesome ones like Kirsten Green and Forerunner and more every day, which is exciting to see. We were actually talking a little bit backstage about the name. So really, when it was, as is always the case, when it's time to do the next set of funds, the partners sit around and talk about what strategies and what we want to do. Mm-hmm. And the Accrue team wanted to continue on with early stage, sort of Series A collaborative strategy in software areas like cybersecurity, fintech, and future of work. We thought about whether we would just, as many larger firms do when they do multiple funds, fund name X and fund name Y. Mm-hmm. But I thought that it would be awesome to choose a name that represented what's core to us, which is we're about teamwork, and we are a truly multi-generational team. We have Gen X, Y, and Z represented on the founding team between Lauren, Vishal, Mark, myself, and Assad. And so that seemed like a really great opportunity. And I was like, okay, if you guys can come up with a name that kind of encapsulates all that and is better, then we'll do it so then everybody can be like a founder of new brand name, right? Like startups rebrand when there's a good reason. And I frankly was like, okay, this is going to be really hard. But when they came up with Accrue Capital, which we thought had a nice double meaning.
I love it.
Crew, team, but Accrue Capital. I was like, it's a no-brainer. We're going to go with that one.
So, and I am a big fan of the team that you put together. I know numerous members of your team. But I did want to spend one more second on this. Jennifer Fonset, who you founded Aspect with, told the Wall Street Journal that part of it was you had different management styles. Could you sort of elaborate on what she meant?
Yeah, I think that, I'll just speak to my management style. Mm-hmm. So I have 4 co-founders in Accrue Capital, so there's 5 of us, and we operate as a team, and we all have equal say in investment decisions, and that's my management style. I've had the good fortune to be in the venture business a long time, since I was really young. But I've always found that particularly in the early stage, having a tight group of partners that are all in it and working together as equals, that's when I've had the good fortune to have some of the best results and some of the best investments that teams that I've been a part of have made. So that's my style. I'm all about sort of team first. And also it reflects back on sort of, because this is about like how do you raise capital, like we're very much, people always say, are you market or team or technology? Mm-hmm. Everybody cares about all of those things. And clearly with our name, like we're all about backing the best teams in the sectors where, we feel like we've got some expertise from an investing perspective. So we're all about team, both for ourselves and also in partnership with the companies that we work with and with our co-investors, because that's another big part of it for us.
Yeah, I'll just add to that just because, when I first came into the venture industry, Theresa was actually one of the first meetings that I had. And just to add a little bit of flavor to what kind of person Theresa is, I'm like a nobody. And I walk into like Excel and I'm like meeting Theresa for the first time. And she's made incredible investments in consumer as well as cybersecurity, which is an area that was of interest to me. And she was the person who gave me the most real advice, not just pandering to me as like this nobody VC, but like, hey, you have to make great investments in the first few years of your life as a VC. And don't just think of them as investments, invest in great companies. And she was so tangible about the things that she said. And then beyond that, we made our first investment together, and she was a coach, mentor, but also just a team player. And so I've seen that just from my perspective as a co-investor in companies, but also as someone who's just, you hear all these horror stories of like people being mean to each other in the VC industry, and Theresa's always stood out to me as one of those people who welcomed me with open arms and also taught me so much. about the industry.
That is really lovely. Well, it's interesting too. So you mentioned Theresa was with Excel for many years. You worked for CRV before co-founding Floodgate with Mike Maples. It's interesting. There's so many people, and probably including in this audience, who either have started venture firms or would like to start venture firms or break into the industry. And it seems like there's been two paths. There's sort of the traditional path where you work for a firm, you gain some experience, you either get elevated through the ranks or you leave to start your own fund. But more newly, we're seeing more people who are just saying, forget it. I'm just going to skip all that. I'm going to start writing checks, build up a portfolio, and hopefully attract an institutional or investment that way. Is one sort of far better than the other, or do you think both of these can work longer term?
You want to start?
So, I mean, I didn't go CRV directly into founding my own firm. I had a 7-year stint doing a PhD, which was completely
in cybersecurity.
Not the path I would recommend if you're really interested in venture capital. But I think, what's different over the last 10 years is when I was starting in 2008, people were like, no one starts a venture capital firm, man. Do you realize that? And it's like, this sounds like a really bad idea. It's 2008. No one does that. Go be an associate at a big firm. And today, there are so many different paths into the market. So I think that's both an opportunity, but it's also a huge challenge. Because when I got started, you just planted your stake in the ground. Mike Maples and I didn't even have a sign on the door. We were subleasing space from Roxrow Pharmaceuticals, and it was like a intelligence test as to whether or not the entrepreneurs could find us. But now, you are amidst huge noise amongst a lot of venture firms and a lot of very talented individuals. The question is, how do you stand out? And so, for the person who wants to found their own firm or who is now an associate, climbing their way through the ranks, you have to figure out, what's your shtick? What is going to make you stand out in this crowd of investors?
And I think just to add to that, I mean, obviously, Ann and I had more sort of the first path that you talked about, Connie, but increasingly today, I think there's some great investors who went out, started building their own individual track records as either advisors or angels, and moved into that. There's obviously a lot of great entrepreneurs who then go and start venture funds.
Right.
So I think there are many great entry paths into it now. And I would say, building on what Ann said specifically, in terms of carving out what makes you stand out, remember what makes you stand out as an investor is investing in great people and great companies, right? So especially if you're doing it, whether you're doing it on your own or in the construct of a bigger fund, it's thinking about that perspective, these people, they're going to be the references for you when you want to raise your first fund or your second or your third.
Right.
So it's really about investing in great people who are trying to do great things.
Right.
And everyone knows that, especially the early stage, the seed or the Series A part of the venture business, not everything works out. So it's not necessarily about being so concerned that every single one needs to be correct, but everyone has to hold together and have a rationale. I'm trying to build expertise in area XYZ, right? And so here's the body of my work, thinking about it from that perspective. And they help one another, and it's also, they're going to help you get the next deal. So make sure it's also a great team, but also an area where you feel like you have a unique perspective and you can build expertise, whether that's in cybersecurity because you have a PhD, which very few people do, by the way. She is a real badass. Or in consumer or in fintech or, SaaS, whatever it is.
Right. Well, that's great advice. So, Ann, speaking of your areas of expertise, you are on the board of Lyft. And as such, I know that we can't really talk specifically about Lyft. But I did want to ask you what your thoughts were about the California law that passed recently, AB 5, which classifies, or reclassifies, I should say, many independent contractors as full-time employees.
Sure. And I can't speak on behalf of Lyft. This is my own personal opinion. What I'm seeing is the companies that are involved with this legislation, they are trying to find the right solution. And what it looks like within legal standards, working with Gavin Newsom to try to come up with what is the right answer here. And I think we'll see continued evolution over the next 6, 12, 18 months. On the investor side of things, though, I do think that there's incredible opportunity in the fact that people think about work very differently now. And I've been talking a lot with my team as well as founders out there about the concept that there's a new social contract between employees and people who are working and their relationship with work. And that's something really profound and new over the last 10 years. And I don't think that we have a world right now that really reflects that. And so we need to figure out solutions for everyone, whether you're a tech worker or not, on how do you now create a new social contract between the person who's working and how they're working.
Right. Well, certainly it's not clear. I mean, I think even a lot of independent contractors are sort of confused about whether or not to sort of feel good or bad about this particular law. But in terms of investments, I guess, how does it impact? So are you talking about, would it impact whether you fund more on-demand companies? Do you think that this sort of could hamper their chances, or
so
what are
we're
there some
early stage? I think we're well beyond, entrepreneurs coming in saying we are the Lyft of or Uber of so and so, right? That was probably 4 or 5 years ago, to be honest. Right now, the types of companies that I'm seeing are really around how do we create new environments for the solopreneur. So as an example, one of the theses that we're working on is we call it the Iron Man suit for the solopreneur. And so if you think about, workers who are on these service marketplaces, for the most part, you have to, as a consumer, have a very standardized service delivered to you. If you're ordering groceries on Instacart, you want the groceries that you ordered to come to you at a certain particular time. And it's not about a relationship with a person. On the other hand, we've invested in a company called Dumpling, which now creates an app for a person who wants to be a grocery shopper and provides them with working capital so that they're able to actually shop and not just put it on their own personal card, but they actually are able to develop a clientele of 10, 20 people. And those people will have a very similar experience to Instacart, except now they have a personal relationship with this person. Maybe that person gets a key to your house and is a sous chef for you. Maybe they also figure out that you need a couple of additional items and they bring those things proactively for you. So we think that there's new opportunities that are getting unlocked because of the consumer mindset, but also because of the way people view this type of work.
I talked to those guys actually recently, and I think that is a really interesting company and theme. Okay, not talking about Lyft specifically again, but a broad number of companies have seen their valuations soar very high before getting onto the public markets, and we're seeing in some cases that hasn't gone so well. Public market shareholders don't think these companies are worth what their private market investors did. Are companies staying private too long?
I think in some cases they are, but it's not even so much that they're staying private too long. So to me, what you talked about with the valuation mismatch, I'll touch on that second. Okay. Why I think some companies are staying private too long has really been what you see is the types of transparency, governance, and visibility that you get when the company is public and has to respond and report to public shareholders. When you stay private too long, sometimes we've seen cases in some companies, like Uber, for example, where that lack of governance and oversight, because they've been private and don't have that same kind of reporting, actually causes problems with the company's core ability to grow and offer, a good environment for their employees and for their service for their customers. I think what you're talking about with some of the recent, WeWork pulling their IPO or other people who are going public at below the last market valuation, that I think just frankly speaks to, and it's happened a couple of times before, in '99 I remember too, but certainly right now is there's a huge amount of late stage capital that's coming in, and they are funding companies with amounts that are larger than what IPOs used to be.
Sure.
And when that happens, they set the valuation. It's not the public markets that's setting it. It's usually one large mega fund at the late stage. And sometimes they're right, and the companies go public up above that last private round, and sometimes they're wrong. And that's what you see when the companies have to go public at, less than the last round valuation.
Right.
And there have been quite a few of those. So I think that's really what's driving it. It's not even just about the time that they stay private, but it's the amount of late stage capital that sometimes is causing, used to be, you would talk about a 25 to 40% private market discount to public. And now in some cases you're seeing the reverse, right?
But I guess why, but the founders are still choosing to take that last round rather than to go public. So I guess, are you trying to advise, I mean, you're both earlier stage investors, but are you trying to sort of counsel them to maybe not do that?
Well, so I'll just start and then hand over to Anne. But yes, we are earlier stage, but I mean, both of us have been with companies that have kind of gone through to IPO and beyond, right? So we're still on the board, at the table when those decisions are being made. Whether it's the last private round or the Series B, my counsel to the companies is the same, is you should raise money that you can, at an amount where you can see how that money is going to either help you get to your goals faster or increase your chances of getting to that goals. And that's how you think about the amount. And then as to the valuation, obviously, you want to get kind of a fair valuation, but you want to think about, okay, I'm going to need to raise money usually every 12 to 18 months as a private company. Will you be able to raise your next round, if that's an IPO or Series C, at a higher valuation? Will I be able to show enough progress in the next 12 months to whatever the post money is on this round, the next round, the pre-money's got to be higher than that. Because you want to build that steady value, frankly, most importantly for your employees. It impacts them the most.
Right.
Yeah, I mean, I think about, I teach this class at Stanford. We call it intelligent growth, because we do believe that there is non-intelligent growth out there. And one of the people who comes in to speak to the class is Ryan Smith from Qualtrics. And I love that case study, right? Because he was at, $50 million in revenues before he even raises his first round of financing. And guess what that gets you? That gets you an $8 billion plus exit. It also gets you basically 50% of that company at exit. And founders don't think about that, right? When you're indulging yourself in what we like to call the foie gras rounds, and you're stuffing that duck so that you can get this gigantic liver and someone else can eat it, like, what's the point of that? That's not for you. That's spoiling your own company. It's ruining things for your employees. Like, we like to think about how to make the best for the early stage businesses. What's the groundwork to do that? And so I take a lot of responsibility for the early stage businesses and the foundational elements that we think about that allows for these companies to then grow and have the right amount of capital for the right time. I think the massive influx of capital at the later stages has created problems.
So speaking about the foie gras round, SoftBank has been involved in some of these deals. Sometimes that last investment that's being decided on, the valuation that's being decided, is being done by SoftBank. I think there's a little bit of schadenfreude in Silicon Valley. SoftBank seems to be struggling a little bit. At least it looks to have potentially overpaid for Uber. Definitely, I think, probably for WeWork. Has SoftBank changed the playing field? If SoftBank doesn't raise a second vision fund, do we go back to more reasonable rounds? I mean, it seemed like a lot of firms were sort of escalating their fund sizes in reaction. People were coming down. I'm just wondering, is this a permanent state of affairs now?
Well, SoftBank's clearly the largest by capital player in that space. I think it will have some impact if, for whatever reason, they're not doing what they're doing. But the reality is there are multi-billion-dollar late-stage pre-IPO investors, many others besides SoftBank. I think the others have proven to be, because the capital, though large, is not like mega large. I think there will still be later rounds. Therefore, companies will still take longer to go public. But I think that there might be a little bit of a market correction in terms of trying to find that right point where the last private round isn't going to be significantly higher than what an IPO would be.
Right. One other thing we've seen, because founders have sort of been in control, I think probably for maybe like the last decade, and so I think to some extent VCs have a little bit lost control over what they're doing, how long they're deciding to stay private. But another thing that we've seen more and more of is dual class shares. I think now we're seeing sort of in a broad way some pushback against these companies that have so much control that the government's sort of worried that they've run away with things. I'm just wondering, as investors, do you have a feeling about do you mind dual class shares? Do you think dual class shares in perpetuity make sense, where founders have them for their lifetimes, sort of no matter how much of the company they own once the company goes public?
So again, this is sort of my own personal opinion. We come in so early stage that we don't see that at the early stage, and most of these decisions are happening right before the IPO, from what we've seen. I had about 5 years ago, a founder asked for dual class shares at the seed stage.
Oh, wow.
And I remember thinking to myself, this is so like prescient. This is like what we're seeing now is like what's going to be happening for the next 5-10 years. It was the only founder that ever asked me for that at the seed stage, and I wonder how much that's pushed forward. But that founder, and I remember I told this person, like, it doesn't mean anything at this stage, right? And ultimately, that's going to come back to bite you if this is what you ask for. And sure enough, the company folded. And so, to me, the best protection for a company is for the company to be a great company. At the same time, I also think that you always want to protect the interests of that founder vision. And so I think what you're seeing with dual class shares or different types of provisions is that attempt to make sure that founder-led businesses are able to run that way. And I continue to appreciate that, because you look at companies that are founder-led and they tend to maintain their value much better than companies that are not. And I think ultimately looking out for shareholder interests, whether you're a public company or a private company, that's something that you should look out for as an investor.
We're almost out of time. Actually, we are out of time, but I have to ask quickly, direct listings. A lot of your peers think they're the wave of the future. Yes, no, maybe?
I think for large companies meaning they've shown they're at significant scale, I think it can be a great thing for them. I mean, clearly both the Slack and Spotify direct listings have done very well. I know nobody likes paying banker fees. No offense to investment bankers.
Guys, thank you so much.
Thank you.
Thanks.